Friday, all of you guys. Happy Friday. Welcome back on another episode of VCTV. 1 second. So my name is Sunny Mohanty. Today we're going to discuss something very different. We're going to talk about mutual funds. Mutual funds has been around since I was born. I've known mutual funds and the investments that people make with mutual funds. Today, I am joined here by three great speakers who have a lot of experience in the space. Currently, I only see Jose Grasa. Hi, Jose. How are you? Welcome back on VCTV.
Thank you, Sonny. Happy to be here with you today.
Okay. I'm going to bring Fabio back on streaming platform. Today we're going to talk about mutual funds, as I say. So I know little about mutual funds. So I'm going to hear from you all today. What are mutual funds? Types of mutual funds? Why should one invest in mutual funds? So on and so forth. My name is Sunny Mohanty, as you all know. I'm based here in Singapore. I represent LATOKEN in Singapore, and I host VCTV Monday till Friday, 8 p.m. Fixed time, and I can see Fabio moving around. Probably it's snowing there somewhere. And Rishabh also joined us here from Dubai. Hi, Rishabh. Welcome back again. How are you?
Hey, Sunny. I'm doing good. Thank you. Thank you for
Still
having
in
me.
Dubai?
Yeah.
Still in Dubai?
Yes.
Okay. Where are you dialing in from, Jose?
I'm dialing in from Poland today.
Oh, so okay.
Also
Why do people go? Okay, so Poland, Dubai, and Fabio, where are you dialing in from today?
From Bologna, to be specific.
Sorry?
I'm in Italy now.
Okay, Italy, Poland, Dubai, and Singapore. Great panel today. Okay, let's start with a quick intro. Jose, let's start with you with a quick intro on background.
There's a lot of disturbance, Sunny, in the call. I think it's important that let's be on mute. The rest of the ones can be on mute while someone is speaking.
Yeah, that's a great suggestion, Rishabh. Really appreciate that. Fabio and Jose, can I request you both to be on mute while the speaker is talking? I'm going to start with Jose. Jose, short intro and background.
So my name is Jose Grasa. Today I am Chairman and CEO of the BizMoney Corporation, President of the BizMoney Fund, and also CEO of the BizMoney TV. Basically, what we are trying to accomplish is bringing business inclusion to every individual in the world. That's our main goal. And we have quite a big team working on that today.
Yeah, I and congratulations on the launch of BizMoney TV.
Thank you.
Perfect. Thank you. Next, I would like Rishabh, short intro on background.
Hey, thank you so much again. Thanks again for having me here. I represent O1X. O1X is investment family office based out of Dubai. We invest in early to growth stage companies. We have been investing into a lot of fintech companies that have financial instruments offered from them for the people. We are quite heavily inclined towards blockchain and crypto, investing in the blockchain space, in crypto space. Other than this, we have a sister concern in India that invests in technology companies, mostly from deep technology. And then we are presently working with an accelerator program called TDFi. TDFi is an accelerator for DeFi ventures. We, as an ONX, is a partner fund with TDFi. It invests and scales ventures from the DeFi space. That's a brief introduction. I'm looking forward for this session.
Perfect. Thank you so much, Rishabh, and welcome back. Next, I have Fabio. Fabio, are you able to share talk now?
Sure. I'm an economist by training, but now I'm involved in an investment bank which has two arms. One is the asset management arm, and the other one is the advisory for innovative companies. In the asset management arm, we have several mutual funds, one of which focuses on innovation. So we call it with the denomination of Industry 4.0, but essentially it covers a wide array of sectors, from biotech to IT to fintech and so on and so forth.
Perfect. Thank you so much, Fabio. So great. Thanks for that intro. Let's talk about mutual funds. So let's start about defining what are mutual funds. While I'm talking to the speaker, others please put yourself on mute so that there is clear communication. I'm going to start with Jose. Jose, what are mutual funds? And yeah, let's start with that.
So, in essence, a mutual fund, there are many types of mutual funds, by the way. There's a myriad of possible combinations, but the basics of the mutual funds is that you have a community. That community subscribes to, as an example, to an X amount of shares, which is called the mutualists. So that means that every person that is going to get something out of the fund also contributes back to the same fund, and an X percentage is covered by that. So that means that the risk is mitigated by everybody which is within the fund. So normally, if you are in that fund and you can get a credit from that fund, it means that a tiny percentage you are going to contribute back to that fund when you get that injection of the cash itself. And believe it or not, if you have 100 people and every one of them, right, contributes with a small percentage, at the end, then you can cover the risk, which is the failure of the X amount of mutualists that are in the fund that eventually are benefiting from the fund itself, that are not able to pay back the investment, which happens, by the way. And that's the essence of the mutual fund. But you can have 1,001 combinations around this. Okay, it's a very, very broad topic.
I know. So you must have invested in some mutual funds already.
Yes, I participated in the X amount of mutual funds in both ways. One as a contributor, but also as a beneficial person. So I had some corporations that also got financed by mutual funds. So that's the reason why I know the whole concept quite well. Personally, I think it's a very interesting concept. You could compare it more or less, but in a different way, to a hedge fund. Because in a hedge fund, what you do is you basically hedge the investment itself, that you can have a coverage, right? And a mutual fund works in a certain way similar, but it's not as similar. Okay, so but it's comparable in certain aspects. It's very technical. So for me to explain it to somebody, it's very technical. So for me to explain it to somebody that has no knowledge at all in finance or understands what the mutual fund is, look at it like this: you have, let's say, 10 apples, right? And you know that one apple will get rotten. So what you do is you take a small piece of each of the other 9 apples, plus the rotten apple, so to cover that exposure that you get from that one rotten apple. So that if that rotten apple is spoiled, right, then you have a coverage with a piece of the other ones. And that's in essence how a mutual fund works.
Okay. Oh, that's a great analogy. I was actually eating oranges. Okay, cool. Thank you, Jose. Next, I have Rishabh. Rishabh, okay, how would you define mutual funds? So this is my first question. Then we'll go on discussing about different types of mutual funds. How do they work? And a little bit dig deeper into that. So let's start with definition.
Okay, so I'll to make it easier for everyone in the audience to understand what exactly is a mutual fund. I mean, definitely Jose gave a great analogy, but I'll like to add on to what he said and put it in a slightly different way. So let's say there is there's a share called for Tesla, and you want to buy it. You really want to participate in its rise, but you do not have the enough money to buy the whole one quantity, right? And that's the minimum. That's the minimum amount you have to pay for buying a one quantity and participate in its rally. Now, what you can do is you gather 20 people and collect the amount and participate in that rally, right? And buy that one stock, and that stocks gets that one Tesla stocks gets good profits. Now you distribute that profits equally in that 20 people. So what essentially you had done is you have collected a pool of money, and you participated in the market, and you distributed the profit proportionally in whatever amount, in the proportion of the amount they shared by each individual. So that's a very easy and that's a definition for a common person to understand what is mutual fund. Now let's go to more technical one, and let's in terms of financial instrument. When you are in the market, you do not want to expose yourself to one particular industry. You want to hedge your risk by putting your eggs in different baskets, and by building a portfolio. Now, if you're not an active investor and you do not have time to check out the market every now and then it's very difficult. It gets difficult for you to manage a portfolio, and that's where index funds and mutual funds comes in, where these people are building these instruments. They have built a mutual fund, and they keeps on rebalancing it. For example, today, let's say today automobile industry were in the last 6 months, it was facing a downfall. So they will rebalance it and will increase the weight on some other industry. So that way the mutual fund managers are doing the work are doing the work of managers, and we are being a passive investors. So we are just investing in that fund, and now that fund is investing into the money in different stocks, in the different instruments. So that way we are hedging our portfolio, we are hedging our risk by putting our money in different basket, and avoiding the pain of being aggressively looking at the screens how the markets are moving.
So
So
what's the
that
difference? Yeah. So what's the difference between a hedge fund manager and a mutual fund manager?
Sure. So there is a very, very, even it's not even a fine line. It's a very vast difference. A mutual fund manager has very restricted number of instruments to assets to invest in. A mutual fund manager cannot invest his portfolio like 20% in stocks and then 30% real estate, where a hedge fund manager can vary the number of asset classes in varies a lot between a mutual fund and a hedge fund. For hedge fund manager, I can go for short positions, I can go for more riskier investments, because as a hedge fund manager my role is to generate more alpha, whereas a mutual fund manager role is to generate consistent returns, because he is being the risk tolerance of a person who is investing into a mutual fund is way less than a risk tolerance of a person investing into a hedge fund. And that's why hedge funds are not for the so-called small investors. They are only for the hedge funds should only operate for HNIs and high net worth individuals, or of family offices, or kind of those corporations that put their money, because they have that kind of a money to invest in a real estate, then take short positions, take leverage positions. Mutual fund managers do not take leverage positions. Hedge fund managers can take leverage positions, because their role is to generate more alpha and not consistent returns.
Nicely explained, huh, Rishabh? Thank you so much. Great. Okay, next, Fabio.
Okay, a mutual fund is a regulated vehicle through which retail investors hire a manager or group of managers to do investments on their behalf, to manage their account, to their savings. Now, why is it important to underscore regulated? Because a mutual fund is subject to a number of regulations by the government and various authorities. And for example, typically a mutual fund has a benchmark, which means that the managers are judged in relation to a stock index or a bond index. So in other words, a mutual fund that targets the S&P 500 promises its clients to gauge their performances against the S&P 500. This means that the strategies that the managers can adopt will not be different from those that target the entire S&P 500. This is in contrast with hedge funds, which are lightly regulated vehicles, and then can take, for example, a huge leverage, which is not allowed for mutual funds, and they can adopt a very eclectic strategy without targeting any benchmark. So, to summarize, it's a vehicle through which retail small investors typically can even larger investors. Typically, it's an instrument dedicated to small investors who can hire professionals to manage the activity.
Right, Fabio. Just want to let you know that your voice has a bit of issue. We can't hear you very clearly. So, yeah. Okay. What are the different types of mutual funds, Jose? Fabio, you can put yourself on mute. Thank you.
I think the other guests made quite a good exposure, Fabio, from a very regulated standpoint. That's exactly how it works and how it is. So you made a very good description on that. And I also think that Risbas, from a operating standpoint, also made a very good explanation. There are some varieties on it. I was trying to explain a different variety, which is normally used because mutual funds can have different purposes. They don't need to be set up just to take stock in a stock exchange. They can also be set up, for example, to give loans out to loans, yes, to people. You know, you can collect money, and then you can basically mitigate that risk and give loans out. And you can even ask the same people that you're going to give loans out to contribute back with a very tiny percentage to cover the exposure. That's a different type of mutual fund that I was explaining, and those are the most what I have seen most successful. What happens is that if you do a mutual fund for a stock exchange, although it's quite different from a hedge fund, but in the essence, the operating model, right, the real basis is not so different, in my opinion. But the way you apply it, that's different, definitely. Okay. So I would say we talked here today about 3 different types. Each of us made a different exposure of a different type of mutual fund, which was quite interesting. And the way I see it is everybody is correct. What they said. So I think I would just keep it to these 3 different types. I could come up with another 100, but I think it's too technical for everybody to go into that. If we are doing this for a the normal audience that has no technical background in finance, so it will get quite complex. And you could even have, let's say, more than one manager, and you could even do compartments just to make it more complex. Okay. You know, and in Luxembourg they're very, very good in that. They have a special setup, okay, not only for hedge funds, right, but also for mutual funds. And I would say the country that has the best, in my opinion, right, the best regulation and is best set up to accommodate that is, as far as I know, is Luxembourg.
Okay, Luxembourg. So, what are equity funds? Are equity funds mutual funds or stock funds?
Is that a question for me?
Yes, Jose, it's for you.
Okay, sorry. Oh, can you repeat it?
Equity funds.
Yes. Yeah, an equity fund is different, right? So let me put it like this. Do you want to have exposure? Yes or no? Do you want to do retailing, where the money comes from? Yes or no? And do you also want to be able to, let's say, be able to apply that to different things? Yes or no? And based on that, then you can have either a hedge fund or a mutual fund, or eventually even an SPV. Because let me put it like this: an SPV can do a lot of stuff,
Right.
and it doesn't need to be a fund, and it can do more or less the same, right? You can also bundle an X amount of people into a special purpose vehicle and do direct investments, not only in private companies but also on stock exchange. So, but once you get to retailing, and Fabio made a very, very good exposure on that, then it's a different story, because then you get into regulation, and once you get into regulation, then it becomes, let's say, serious. And once it becomes serious, then you need to have very high professional people to handle it, that know exactly what they can do and what not. And it costs a lot of money to maintain it.
Right. Okay. Thank you, Jose. Rishabh, just want to ask you, how do you explain to a beginner about, if you were to explain hedge for types of different hedge funds, like you give your analogy of apples. Yeah. What are different types of mutual funds? Sorry.
Okay, so Apple's was Jose, so I'll not take his credits. It was Jose.
Oh, really?
Yeah. So in terms of types of mutual, I mean, as Jose explained, and by the way, I was, Jose, I was not trying to say that, that they are hedge funds and mutual funds are not the same. It was just that in the way of their operations and the asset classes they can include, in that perspective, there's quite a difference between a hedge fund and a mutual fund. But yeah, anyways, your point was very well made. So now talking about what are the types of mutual funds, as it said. So if you're talking about equity funds, so equity funds will be majorly exposing themselves to stock markets. Now they could be a hybrid of equity and bonds. Not that depends, that depends whether you want a regular income, then you would go for a fund that is more into that gives you a dividend return, or if you want a fund that is not there for regular income, and you have saved it for your, let's say, 5 years, 10 years down the line, and you do not want returns before that, then you go for a growth fund. In growth fund, you do not get any intermediary returns, but you get a return at the end of those 5 years. So you can take more risk, because you can be more versatile, and you do not have to worry about your regular day-to-day expenses for coming from that fund. So now there could be a tax saver fund. So here in India, and I don't know whether what the situation is in different financial ecosystems, but when you talk about India, we have a tax saver fund. So that tax saver fund is, so if you can allocate on 150,000 INR, so somewhere around 100, somewhere around 1,000, 2,000 INR, $2,000, somewhere around $2,000 per year, to a tax saving fund where you will not be taxed, you will be tax deducted, as well as you can you can put that as your savings. So it's called ELSS, equity linked savings scheme. So that's called ELS, a tax saver fund. Then there is a dividend fund. Then there is a growth fund. Then there could be a hybrid fund of bond, so which invests into government bonds. So if you want regular yearly returns, so you can invest in a bond mutual fund where you will get the coupon payments in the terms of an income every year, and at the end of the year, and at the end of the tenure, you will get your principal back. So in whatever the kind of mutual fund it is all differentiated based on what asset classes they can invest in, what tenure they have, what's the tenure of investment, and what is your risk tolerance as an
Okay,
investor.
got it. Rishabh, because you've also in the crypto space, so if you were to advise, just a personal advice, not a professional advice, if you were to advise someone to invest in Bitcoin or mutual funds, where would you advise to put their money?
So first, as I always say, and I will be saying this in bold and capital letters. So this is not a financial advisory advice. Please, please use your own diligence to do your own research and invest. This is my personal opinion. Now, having said this, there are funds that have come up with a mutual fund kind of a scheme in cryptocurrencies. So, for example, there's a fund called Bit Droplet. Now, Bit Droplet, what it does is it has made an SIP plan. So you invest few $100, and that is collected from multiple people and put it in a SIP format, right? SIP is a systemic investment plan. That is a very famous, rather a very popular category of mutual fund investment in the youth, because in that systematic investment plan what you have to do is every month there will be a deduction of few hundred rupees in terms of INR, or let's say few tens of dollars. Every month there'll be a deduction, and it could be as less as $7, as less as $7, right? So it can start with $7, goes up to as much as you want. So you can put that equal amount of money every month, and that gives you a dollar cost averaging. So now you are not buying everything at the same price, you are buying it at different prices. If the prices are going down, then your portfolio will, your dollar cost averaging will go down. So that's a very famous popular instrument that has come up in the amongst the youth, because they do not have a lot of money at one, but they do have, they do want to allocate a certain proportion of their income into these funds and grow, make their wealth. Similarly, Bit Droplet is an operating an SIP. Now there are multiple mutual funds into in the crypto space where they are allocating certain portions in the top 10 market cap, that includes Bitcoin, Ethereum, Ripple, and whatnot. So they invest in those top 10 market cap, rebalance the portfolio. They are coming up, but I'll be very clear: the regulations do not allow it. The regulations do not allow any financial instrument to operate in the space. That's why no ETF till date is regulated. People, a lot of exchanges, a lot of financial grayscale investment trust has even which is the most hyped about fund in this space recently, with their large holdings in Ethereum and Bitcoin, coming from a traditional space. So even they're trying to build an ETF
Right.
is another kind of not a mutual fund, yes, but kind of a fund which operates in a similar way. So yes, a lot of people are operating, and I think that's the best way to invest. Diversify, it helps you in diversifying your portfolio a lot. So yeah.
So tokenization of shares. So is it an asset class totally different from the traditional shares and stocks that we talk about?
In a way, it's just getting giving going shares, taking shares digital. That's it. I mean, tokenization of shares, a lot of companies are doing it, and it is definitely a growing space. But it's not different in I mean, when we talk about mutual fund, this it's quite a different whole together conversation, and it might take to a different tangent. So we can keep it for
Yeah,
discussions in the later webinars. Yes.
definitely. Thank you, Rishabh. Fabio, uh, okay, I think he's frozen.
Yes.
Oh, Fabio, hi. Okay, I saw you went static for a moment. So let's talk about different types of mutual funds.
You're on mute.
Fabio, you're frozen. You're on mute.
Left.
Okay, he's out of the streaming now. I don't see him. All right. So what are the advantages and disadvantages of mutual funds? Since Fabio is here backstage, let me just bring him back to the streaming. Hi, Fabio. We can see you.
Can you hear me?
Yes, please. Yes, we can.
What was the question, Sonia? I couldn't hear it.
So I was asking you, what are the different types of mutual funds that we have?
Okay, mutual fund. The typical mutual fund is a fund that invests in equities.
Little
So
louder,
that's how
please.
they started. Then
Little louder.
they added also bonds, government bonds and corporate bonds. Then with time emerged the so-called balanced funds. So they invest in a mix of bonds and equities, say 60% equity, 40% bonds. And now we can include in the space of mutual funds also the REITs, REIT, which are real estate funds, and they essentially invest in, as the name says, real estate. It could be residential, industrial, office, and so on and so forth. These are the three main categories. Lately, actually, over the past, let's say, 10 years, a particular kind of mutual fund have emerged and are the ETF. ETF are sort of passive mutual funds because they track an index. For example, the mutual fund can track the Dow Jones, okay? And so the managers of these ETF, which is a peculiar kind of mutual fund, will make sure that their investments replicate exactly or as close as possible the composition of the Dow Jones. Most people like this because the management fees are very low. Typically, I don't know, less than 1%. They can range between, I don't know, 0.2% to 0.75%. Compared to the mutual funds where you have fees, management fees of 1.5%, entry fees, exit fees. So it's much more costly for the average saver. Let's say other innovations that have taken place recently are these ETFs that, despite claiming that they are somehow passively managed, in reality they adopt very sophisticated or more sophisticated strategies, and they're somehow moving from being mere follower of an index to something akin to hedge funds. So without much leverage, but adopting sophisticated strategies to ensure that, despite or irrespective of market conditions, the returns on investment is positive.
All right, great. Thank you so much, Fabio, for that. So the next question I have is, what are the advantages and disadvantages of investing in mutual funds? And I would like to start with Jose.
I think that's a very simple answer. The big advantage is that you spread out the risk over an X amount of people. And you can, depending on the type of fund, you can diversify based on the mandate. all these structures that we are talking about, right? They are all binded by more or less by a mandate. So you can have a mutual fund that can be very restrictive, but it depends on the fund setup, how you're going to do it. But maybe I would like to address something that I was been thinking while the other speakers were talking. In the past, if we talk as retail, right, the banks, in essence, were taking over the retail market, and they themselves were doing initially quite a good job, in essence, that they would stick to their core business, which is lending money out to people that need, getting an interest, and then part of that interest they would get back would be to come in the revenues of the bank itself, and a part of that those revenues would be distributed out to the people that would deposit money in the bank. The problem is that it has become over time so complex, with so many different types of financial engineering, that the majority of the let's say account owners does not understand, and they really did a bad job at that point, and a lot of banks got in a very, very bad shape due to this very hard financial engineering that not every time worked out quite nicely. So this is what I was thinking in the whole process, is that it's all interesting, but do we really need so many complex financial instruments? Because at the end, what we are facing is that we are looking at constantly speculation, right? There is no substantial asset generation really that you can say that it becomes more worthy. A lot of what we are facing today is constant speculation. Even if you look at Bitcoin, it has more or less the same principle. And I'm not against it. What I'm just saying is that if we are too greedy, right, one day it will come down more or less, and because all this artificial going up, one day it will just explode and get down, and a lot of people get hurt. And I understand one thing is that economy is about levering from one person to the other, because in essence, if you have 10 people and each of them have let's say $10, right, and you start running this economy, then after a certain time, somebody may have nothing, a few may have, let's say, 12 or 13, others may have 5 or 6, and in the stock exchange, it's not that different. Okay, a small, tiny percentage of people will accumulate a huge amount of benefits, while others just lose everything. So you need to understand the whole concept that is underlying under this. And I think it's a very, very good thing that we have regulation, because if we would not have regulation, I can tell you that this would be like Far West, and the outcome would be much and much worse than we have been facing today.
Great. Thank you so much, Jose, for those great information with our audience and other speakers. Next, I would like to go with Rishabh.
Yeah. Can you please repeat the question? I think advantages of mutual funds, correct?
And some disadvantages as well, like that we can
Sure. Yeah. So in terms of, I think already it has been mentioned a lot of times, but I'll still put it together to put things into perspective. In terms of advantages, mutual funds offers one thing that brings diversification. So, and in a way, you can diversify your portfolio. You can hedge your risk by the industry, by eliminating the unsystemic risk, right? You cannot take care of the systemic risk, but you can definitely remove your unsystemic risk from the market by when one industry goes down and the another industry is evolving. Your mutual fund will take care of it. You need not get actively involved and do the panic selling or buy in FOMO. It's just your mutual fund will take care of because the portfolio managers sitting running the mutual funds will be able to rebalance their portfolios, rebalance the portfolio of the mutual fund. And that's a very simple advantage, that you're able to build your wealth by putting certain amount of money every at regular intervals. So it's not that you're slowly building your wealth for the things that you have planned for the 3 years down the line or 5 years down the line. So that's how. And when I'm talking about the traditional markets, but if it comes about the uh, crypto markets, then rather I'll say 3 months down the line or 6 months down the line, the mutual fund tenure, right, duration. The disadvantages would be, as Fabio very well explained, the load, the entry and exit load, the high fees. Obviously, when a portfolio manager is taking care of your investments, they would charge the fee, and these fees are not they are significant fees. So just like hedge funds operate at a 2 and 20%, mutual funds operate at a 2 and 20, as in like 2% of the asset under management and 20% of the profits. Similarly, mutual funds do not operate at what we call as loads. So it is a payload, the exit payload or the entry payload. So they, either depending on which kind of fund it is, so there'll be an entry payload load of a certain percentage. It could be like 1.5% or 2%. That's the range mostly. So these managers, mutual fund manager, charge you that amount of your portfolio as fees to them. So that decreases your alpha, right? Even though you have gained a lot, but your alpha will decrease because you have to pay the fees to these managers. So this is one of those disadvantage. Then restrictions in terms of liquidating. So when it comes to liquidate let's say your duration of the fund is 3 years and you want to get out of it in 2 years, then you have to pay a penalty. You cannot just go and sell your share, just like you were free to do that if you were managing your own portfolio. But since a portfolio manager is operating your portfolio, he will charge you a penalty penalty for exiting it at an early at a time which was not defined in your mandate. Then the third is the mandate oriented, which Jose very well explained. That one of the it's rather an advantage or a disadvantage. It is both actually. It lies in the middle of it. So having a mandate makes it very important, very restrictive for the fund to not expand its asset classes. So let's say some asset class is evolving at a very fast speed, and you could have actually captured the returns and generated more alpha, but since your mandate does not allow it, so you cannot do that. So yeah, that would summarize it. And just to add one more point, I might have to leave before this session ends. So just wanted to thank you for. I'll be here for another couple of minutes, but thank you for Sony for a lot for having me here again and participate in this
Sure.
insightful discussion.
Thank you, Rishabh. Thank you. Well noted with that. Next, we have Fabio. Fabio,
Yes, what are the
you-
advantages
yeah.
of investing in mutual funds? I'm talking about regulated mutual funds, not, let's say, the exotic kind. The advantage is that you get a professional a team of professionals managing your savings, so you don't have to worry about the daily movements in the market. You have a fairly diversified set of investments, and you have a benchmark, so you can judge the performance of the fund managers vis-a-vis an index or a combination of indices. What is, and by the way, the regulation imply that the mutual funds have to have audited accounts, administrators, so a whole set of checks which make it very difficult, if not impossible, for the managers to steal the money, to do frauds, to engineer some sort of fraudulent business. So you pay for this diversification, professional help, professional advice, and the security of having the government to check on your money. The disadvantage is fairly obvious. These mutual funds can only go long. In other words, they can buy or sell securities that they own, which makes it prone to market movements. In other words, if in a certain year, in a certain month, over a certain period, the bond market, the stock market, where the fund invests its money, goes down, turns negative performances, the mutual fund will turn negative performances. Maybe if the fund managers are very smart, they might limit these losses. But if you invest in a mutual fund that tracks the S&P 500 and the S&P 500 drops, let's say, by 20%, it's very likely that your money your savings, your position in the funds will drop by 20% in value. That's why people invest in hedge funds. The hedge fund can go short. So in theory, even when the market turns down, the mutual fund, if smartly managed, can turn a positive performance. So these, in my view, are the elements that need to be taken into account when you make an investment decision and when you choose whether to invest in a regulated vehicle or in a likely or unregulated vehicle.
All right. Great. Thank you. Thank you, Fabio. So, because you are also an economist, can you, I mean, it's not, as everybody says, disclaimer, it's not a financial advice, but any mutual funds, best large and mid-cap mutual funds to invest in 2021?
But I don't give advice because otherwise I will have the regulators on my back. What I can tell you, and I hope that this doesn't come as a surprise, at Golden Eagle we have a set of mutual funds that cover pretty much a wide array of sectors, from bonds to shares, and we have our flagship mutual fund that deals with innovation. So we invest in technology. It's been very successful, not surprisingly, because the sector has been booming. But we pay particular care in following the companies which have a very good prospects over their future developments. So in a sense, it's a way to take a bit of risk, but with the expectation of making profits in excess of what you can get on, let's say, blue chips or major indices. By the way, it's a global mutual fund, so we target companies all over the world. The emphasis is on the US because there the IT sector is more advanced, but in general we look at all possible opportunities globally, which also how can I say brings me leads me to make a remark. When you invest in a fund, you have several dimensions. You can invest in sectors, in geographical areas, in a group of countries, say emerging markets, advanced economies, BRICS. Now the acronym is not fashionable anymore, but no, the financial markets have evolved immensely over the past 20 years. You can find easily a niche that suits your preferences or your expectations, both in shares and in fixed income.
Sure. Thank you, Fabio. Next question for Jose. Mutual fund loans. What are those mutual fund loans? How do you explain those?
They are not so common, and they are. It's like more. It's more recent that they came to the table. Let me put it like this. Normally, what you do is you use a hedge fund. So you don't use a mutual fund for that. So you use a hedge fund, and that hedge fund can have, let's call it, compartments. Each compartment can do different thing. One compartment can do in bonds, the other one can do in equity. But you can also take a compartment and lend money out, almost on a peer-to-peer lending system. At the end, you are spreading out the risk, and you're also taking a management fee to manage that, because you have separate managers that each manager is handling one part, okay, of the exposure and the investment. And obviously it needs to have a adequate mandate to go with it. You cannot eventually not do whatever you want or lend to anybody. There are criteria for that. But what I see is that the mutual fund concept, that you are bringing an X amount of people together that give this mandate that they would like to go into lending. Okay, and I must say that the more appropriate structure is a hedge fund. Okay, I have not seen it in a mutual fund, maybe one or twice, and because they normally like to invest into liquid equity on a stock exchange, and the reason is that they can buy and sell and convert into cash immediately. If you go to the private market, you cannot convert a loan which is given out into liquidity. So you need to wait until that money gets back. So it creates some challenges, but it's pretty possible. It's not uncommon.
Right. Thank you so much, Jose, for that. So that brings us very smoothly to the end of the show today. Let's take some closing remarks. I would like to start with Fabio. Fabio, what's your closing thoughts for the show and the topic today?
My final remarks are quite simple and straightforward. It's very good that media take up the task of educating people, because often things that for us professional look obvious or a fait accompli, for many people are sort of cloudy, and the jargon that we use often is not so straightforward for the average saver. So it's important to engage in this education process, starting essentially from the basics, as we've done today. In the good old days, you could only put your savings in a bank, and that was it. You would gain a rate of interest, and you'd be happy. nowadays you have hundreds of, thousands of possibilities, and this requires a process of learning, which we as professionals and as media people need to devote some attention. And VCTV has done a good deed in starting this kind of task.
Thank you, thank you, thank you so much, Fabio. We learn a lot from you all the time. And exactly, I think you have to invest in diversified portfolios. Like gone are those days, it was only, investing, putting our money in the banks. Yes, thank you so much for that. Jose, over to you with your closing remarks.
So my closing remarks goes in a different direction, but it's not uncommon that I have different directions. So my closing remark goes to the following: is that whatever we discussed today, right, there is a risk involved.
Right.
And that means that people need to be conscious that if they select something which is not government backed, like a deposit on a bank account, that there is a considerable amount of risk involved. That risk can be mitigated, can be even limited, but there's always risk. And so we have seen along all these years, right, that from time to time we have these blow-ups, like in 2008, 2002, etc. So if you are okay with it, that's fine. If this is not something for you, then you are not able to get out of that blowout before it happens, right? Because not even the professionals know sometimes when it happens. When it starts, it's like everybody is running around to get it done. Then I would say this is more for the professional and the technical guy that wants to invest, and less for retail. And why do I say this with a certain concern? Because I hate to see that people that have been saving a whole life, in some cases like 30, 40, 50 years, for their pension, right? And suddenly use either a huge tranche of that money or the whole money, because they went into a structural financial investment that they don't understand. They rely on the manager, and that manager is there definitely not to scam you, to do a good job. True. But he cannot control all the ingredients, right? So you must be aware that what you do is you're conscious that that's what can happen. So if you're not in for that, then I would say that I would go back to the old basic traditional banking, which was something that was working properly, So, and I'm a finance guy, but I'm also concerned about people that are not so wealthy, and I know a lot of cases that from a lot of people that definitely lost a lot of money, and that's my concern.
What about the recent GameStop?
The recent?
The recent Robinhood and GameStop incident.
That it always happens from time to time. The problem is that people maybe get a little bit blind. It's like the gold rush, right? Even I have some cases that for example, that I said to somebody, don't do that because you're going to lose the money. But the issue is that they are so their mindset is so like gold rush that whatever you tell them, they don't listen. They just need to do it. And afterwards, they say, well, maybe if I would listen, I would still have the cash. But it's too late, right? So you don't need to the problem is you let yourself go by emotions. Correct. And you cannot let yourself go by emotions. You let yourself go by facts. Money is about facts and about numbers and not about emotions. And every time we see these fluctuations, because it's all based on offer and demand, then you understand that it's a lot about emotions. For example, why, if one day a president says something, why does the stock exchange need to change? In essence, that's what happens, but it's about emotions. It doesn't make any sense at all.
market is driven by sentiments, news, and everything. Yeah, sure. Thank you so much, Jose and Fabio, for your time today on a Friday. Really appreciate your time and the insights. I hope our audience have had a good session understanding the basics of mutual funds and the investing in mutual funds if they wish to. But this is not an investment advice, as one of disclaimer was already given by all the speakers. So thank you so much. And I would say I'll be back next week on another topic, another set of speakers. I'm sure both Fabio, Jose will be there as well on another panel, one of my other panel. And till then, happy Friday. Have a great weekend. And I will catch up with you back next week. And yeah, have a great day. Bye.